All right. Thanks a lot, Vince. And thanks everybody for being here. So couple quick warnings. One, I have a lot of slides. A lot of them are going to be up for just a couple seconds. They're really there for me just to jar an idea and for you just to see a visual kind of up, down, green, red. Don't worry about reading them. They're available on the website so you can have them and look at them later. I call it speed sliding. And if you do have questions, happy to get to them at the end. So we're going to talk about this idea of hashtag get off zero. Why hashtag? Well, I'm on Twitter a lot, so at Mark Yusko if you care. And I created this hashtag as a reminder that, I think the most important decision for investors today in the current environment is to get off zero exposure to digital assets. And I'm going to try to make the case of why you can't afford to not have exposure to blockchain technology and digital assets. So the two pictures on the front, left-hand side is just what's going on in blockchain and all of that. But on the right-hand side there's this digital divide. And many of you are in the financial services business, financial advisors, asset managers. And what's interesting, if you ask anyone over 35, who's your broker? Oh, Merrill Lynch, UBS, whatever. How much gold do you have? I don't know, 3, 4, 5%. How much Bitcoin do you have? Zero. What are you talking about? Bitcoin? Are you kidding me? It's a Ponzi scheme. It's a scam. Ask anyone under 35, who's your broker? What are you talking about? What's a broker? I have a Robinhood account. How much gold do you have? Are you kidding me? Gold? Who would own gold? How much Bitcoin do you have? I don't really want to talk about it. Why not? Well, it's a really big percentage of my net worth, and I'm kind of embarrassed. So a big digital divide. We're going to explain why here in a second, if I can make my slides work. There we go. All right, so I always start with words of wisdom. A plan conceived in moderation must fail when circumstances are set in extremes. So everything that we do in investing is based around this plan that was conceived. It's actually 70, unbelievable, year-old technology, the CAPM. And it goes to this idea that stocks and bonds have a certain relationship and that valuations are normal and interest rates are normal and that growth is normal. None of that is normal. We are in an extreme situation, and that plan that we've looked at, which is a diversified portfolio of stocks and bonds, just isn't working. We always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. The next decade is going to witness some of the biggest change that we've ever seen, and you got to get out ahead of it. And the four most dangerous words are, it's different this time. So we have this dilemma of highly priced assets. So again, this chart, all you got to see, blue line, sometimes it's high, sometimes it's low. The blue line is the ratio of gold to stocks. And back in 1980, okay, you could have bought all the stocks in the US twice with all the gold in the world, but nobody wanted to own stocks. In fact, Business Week had the cover saying the death of equities, that no self-respecting fiduciary should ever own equities again. It's actually a pretty good time to buy equities. 20 years later, after the bull market, where Warren Buffett said that valuations were stupid, his word, what did the cover say? Oh, now everybody should buy. Everyone's getting rich but me. And what did people do? They bought at the top in 2000, and then we had a terrific bear market. And if you bought the 5 biggest stocks in 2000, Microsoft, Intel, Qualcomm, Cisco, and I can remember the 5th one, and you bought them and held them for the next 20 years, you actually lost money. Think about that, 20 years lost money. So we're not as bad as we were in 2000 today, well, almost, and we'll talk about why that's important. So back in 2000, I actually showed this actual chart to my board at UNC, and Jeremy Grantham in the bottom line in the yellow said that stocks for the next 10 years, not the previous 10 years, but the next 10 years, because of stupid valuations, would have a negative return. And my chairman at the time said, Mark, you're not allowed to use the letters G, M, or O in a sentence ever again, because that's impossible. That could never happen. Well, it actually did happen. Now, why did my chairman think that it was impossible? Because in the center column from 1926 to 2000, the risk-free rate averaged 4%. So basically you got 4% for taking no risk, for being in cash. Now, in order to make a return, you have to take risk. You have to take one of 4 risks. You can take credit risk, equity risk, illiquidity risk, or structuring risk, just a fancy term for leverage. So if you took credit risk and you bought a bond, the long-term return was 6%. Okay. If you bought equities, the long-term return is about 10.5, 11%. You got 5% more, 7% above risk-free for stocks. Illiquidity risk, private equity, private real estate, private energy, private debt, another 5%, amazing. And then structuring risk was variable, right? Sometimes leverage works, sometimes it doesn't. The problem was in 2000, risk-free had fallen to 2. Credit risk was down to 2 because bonds, see the 10-year yield is what you're going to make the next 10 years in bonds, right? Whatever the 10-year yield in treasuries is, that's going to be the next 10-year return on bonds. It's pretty simple. You buy a bond yielding 4%, you're going to make 4%. Today, you buy a bond yielding 0.6%, you hold it for 10 years, you make 0.6. You don't make 6, you don't make, negative, you make 0.6. Equity risk premium, though, was negative. So you were going to have a negative real return over the next decade. Now, illiquidity premium was double. Why? Because nobody wants to be illiquid. At the top, everybody wants to own liquid stocks, and the illiquid stuff gets really, really cheap, which is why Warren Buffett is buying private companies like Snowflake instead of public companies. So where's actually my son works, which is kind of nice. So here's the thing. For 20 years, from 1980 to 2000, stocks were awesome. They compounded at 13.8%, upper right-hand corner, and they almost never went down. They only went down a couple times, and the average drawdown was only 10% intra-year. Since then, in what I call the new abnormal, so we've gone 20 years, the average return over that 20 years is 4.6%. There's a technical term for that. That sucks, right? And everybody says, oh, but last year was great. Yeah, fine. But the downdrafts have been twice as bad, or about 60% worse at 16.5%. So from 2000 to 2010, you actually did not make money. And look at the green line. The green line is what we need to make, 6% real. Look at the blue line, the red line, and the purple line. A diversified portfolio, 70-30, over the last 20 years has not made 6% real. Scary. But what about 20 years? And people say, 10 years isn't long enough. How about 20 years? Over 20 years, if you bought and held stocks, you made a little over 8. You bought and held bonds, left-hand side, you made a little, about 6.5. The average institutional portfolio made around 8%. But here's the problem, okay? The average endowment made 9.5% with less risk, and the best endowments made 12% with less risk. Well, how'd they do that? Well, the average endowment just had better asset allocation. They didn't just have stocks and bonds. The top endowments had a lot of exposure to venture capital and innovation and new ideas, which is what we'll talk about. But here's the problem. The individual investor, right? All they had to do is buy stocks or buy bonds or buy a mix. But what does the average individual do? They buy what they wish they would have bought. They chase the hot dot. So they averaged 1.9% for the last 20 years. Horrible. So here we are back to the future. So here's Jeremy's latest chart. So he's saying that US stocks, left-hand side, are going to have a negative 5.6% real return. Now, if you add back 2.2% for inflation, you get a minus 3.4% compounded return over the next 7 years. Now, with alpha, the yellow square, you might be able to get to flat, to zero. Zero, again, technical term, that sucks. Emerging markets, particularly emerging market value, is actually going to have a very nice return from here. Bonds, stinky, right? Bonds are just return-free risk today. Very little benefit to owning a portfolio of bonds. And inflation-linked bonds, even worse. So where do you hide? What do you do? Well, it's not just Jeremy, right? John Hussman. Look, I'm not a statistician. I don't have a PhD in statistics, but will you grant me that the red line and the blue line on the left-hand side are highly correlated? One would say yes, like 96, 97% correlated. What the blue line is the expected forecast return for the next 12 years from current environment. The red line is what actually happens. So today, negative 1% compounded for the next 12 years. It's probably what we're going to get. Rob Arnott on the right-hand side says the same thing. Now, Rob Arnott and research affiliates tell us that the security market line is basically flat. You're not getting paid in traditional assets to take risk. So don't do it. Now, the only place you're getting paid to take risk is in emerging markets. And then I'm going to talk about innovation in an asset class where I think you can get really well paid to take risk. So are we at an inflection point? Now, there's this guy, Samuel Benner. He wrote this book in 1864, and he laid out this chart. It was republished in 1901 by this guy, W.D. Gann. But this actual chart on the bottom was created in 1864. So let that sink in for a second. In 1864, this guy said the market was going to go up and down and up and down and up and down. And he predicted the top in 1929, the top in 1964, the top in 73, the top in 2000, and he said there was a top in 2018, and that this year would be what's called a panic year. In 1864, he said 2020 would be a panic year. No one would debate, normally we'd be doing this over a real lunch instead of by Zoom. No one would debate that this is a panic year. We had a 32% drawdown in stocks. So here's the real problem. US equities are overvalued on every measure. Left-hand side, average valuation between 157% and 87% overvalued. Right-hand chart, that average is 132% overvalued, second only to 2000. We need a 57% drop to get to fair value. Now remember, corrections don't just go to fair value, they usually go below fair value. So because for every day above average, you have to be a day below average. That's how averages actually work. It's not Lake Wobegon. But here's the real problem, the left-hand side here. The red line on the left, stocks should go up, right? Stocks have dividends, they have inflation embedded in them. They should go up. But the blue line, remember, for every day above the red line, it has to spend a day below. We've been above the blue line for this entire new abnormal period, but for about a month and a half in 2009. And so we've created this bubble, which now, if you look on the left, the 135, it's the worst it's ever been relative to its long-term regression. And on the right-hand side, the relationship of the PE ratio to inflation is now exceeded 1929. So it's only been 2 months in the history of markets where it's been worse than today. And that was in September and August of 1929. And even the craziness of 2000 pales in comparison to today. So really crazy. Now everybody says, oh, but what about forward valuations? Well, we're now second to 2000 on the left-hand side. And here's the crazy thing, right? Saying that stocks are cheap because we're not as stupid as 2000, when the next 3 years we went down 84%, is like saying, getting pulled over for swerving late at night and saying to the officer, well, I had to drive. I'm not as drunk as the guy in the back seat, passed out. No, you don't have to drive. Call Uber or Lyft. And on the right-hand side is one of the scariest charts I've actually ever seen in my career. This is Ed Yardeni. And these are called the Blue Angels. And basically it shows you from 10 times valuation to 19 times valuation. We've just never been above 19 times valuation until now. And we got to 19 times, we had the correction, and now we've inflated the bubble beyond reason to 22.9 times forward. It's just crazy. Now, I love this chart on the left-hand side, which says the orange line is profits and the black line is stocks. Now, if you think about it, on the left-hand side of that chart, they should be highly correlated. But then in 99, 2000, the black line started to go up, yet profits were flat. And you can see the headline on the right-hand side, companies choose to rethink a quaint concept called profits. That was ridiculous, right? It was a stupid idea then to say, oh, well, we don't need profits. It's about eyeballs and it's about page views. It's not. It's actually about profits. And then you can see that we had the big crash, and then the orange line, the black line on the left-hand side got correlated again. And now profits have been dead for almost a decade, right? There's been no increase in profit, yet stock prices are up about 50%. That will end badly. And this idea that profits no longer matter, here's the thing. So there are companies out there selling at not 10 times earnings, but 10 times revenues. And the red lines on the left-hand side are the same level as in 2000. And Scott McNally in 2000 summed it up. He said, if you pay me 10 times revenues for my stock, okay, it's ludicrous and you will lose money. At 10 times, I have to get a 10-year payback. I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders, assumes I have zero cost of goods sold, which is very hard for a computer company, assumes zero expenses, really hard for 39,000 employees, it means I pay no taxes, which I go to jail for if I don't do that. And so Sun's stock went down 98%. So we will look back in 2, 3, whatever many years and say, what were we thinking? What were we thinking paying 10 times revenues? Now here's a crazy thought. Since January 2018, when we would argue that the world got stupid, kind of in the post-election rally, the world just got stupid. Valuations got to 2000 levels again. Since January 2018, if you bought long bonds, the gold line, you've actually outperformed stocks. Stocks really haven't done that well. They're up about 7-8% compounded over that 2.5 year period. And since October, since the Khashoggi crash, okay, bonds have crushed stocks. So this idea that you should have lots and lots of stocks and no bonds just doesn't make any sense. All right, so how do we get here? So my friend summarizes the situation best. I recall a time when I didn't know the names of global central bankers. I long for those days to return. There's no answer in the available literature to the question why a government monopoly of the provision of money is universally regarded as indispensable, as it has all the defects of every monopoly. With a gun, a man can rob a bank. With a bank, a man can rob the world. And I was reading the paper today that Congress wants to replace the dollar bill with a coin. They already done that. It's called a nickel. So what is a central bank? Well, a central bank provides oversight, monetary control, and they act as the lender of last resort. So they are supposed to lend when no one else will. The problem is, all that really does is save the banking sector, and everybody else is left hanging because central banks only lend to banks. So truly, central banks were created. Here's how it is. So basically, the United States didn't have a central bank. And we started the country, and we started the first national bank and had a 20-year charter. And then we had the second national bank and had a 20-year charter, but they were not central banks. And the Europeans had central banks, the first in the Netherlands, controlled by the Rothschilds. And the Rothschilds used the central banks to finance their wars and some bad stuff and basically create a banking cabal or a monopoly. And Andrew Jackson said, nope, I am not going to renew the second national bank charter when he was president. And basically said, we're going to have, local currencies. Everybody can issue their own currency. So you actually had companies issuing currency. You had local states. Texas had its own currency. Of course, Texas had its own currency. And it was a massive failure. So the banks started to come back, and JP Morgan started his little bank. And I love the quote from JP. I like a little competition. So the thing in the middle is there was this thing called the Knickerbocker Trust. And these trust companies were chartered to provide competition for the banks because the banks were getting too powerful. And so JP spread a little rumor that Knickerbocker Trust was having problems, and there was literally this run on the bank. So he got rid of the competition. And then JP Morgan's father-in-law was this guy, Amory Aldrich. And Amory Aldrich was the most powerful senator in the country. In fact, you can see he was basically showing Uncle Sam how it works. And he created this thing called the Aldrich Plan. And they met, you can't make this up, they met on Jekyll Island. So they created this monster called the central bank, the Fed. And it basically gave all the power to big business. And it basically was going to foment a plan to steal wealth through inflation from the masses. And so Thomas Jefferson said, I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation. So we had the inflation in the 70s, now we're in deflation. The banks and corporations that grow up around these banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. Okay, think about that. He said that in the 1700s. Now I'm 6 weeks into a road trip. So we started in North Carolina, we drove across the country, we stopped in Oklahoma to see my father-in-law's 84th birthday. Then we went out to California to see my daughter who just had a baby. And now we're driving back, and I apologize for the hotel room in Phoenix, of which I am one of 3 people at this hotel. And here's the crazy thing. I have seen more homelessness in the past 6 weeks than I've ever seen in my life. It is so bad. Anyone who thinks the economy is recovering, they have not been outside. It is horrible. Santa Fe, New Mexico, 1 out of 3 businesses boarded up. Shopkeepers saying they're done. Santa Monica, holy moly. They had to erect a 7-foot tall statue of a homeless person to try to, create public awareness, although you didn't have to look very far. Every block, homeless, tent cities everywhere. The idea that, I actually wrote about this 4 years ago, that basically, Trump was the first president since Hoover to have no experience. And I thought that we'd end up with Hoovervilles all over, and we'd call them Trump towns. And that's kind of where we are. Now, here's some funny things. I don't know if any of you watched this movie, Stranger Things, but there's this show called Stranger Things. And it was kind of weird. I was watching it, and I noticed that the Federal Reserve Building and Hawkins National Lab look eerily similar. And in Stranger Things, there's this thing called the Mind Flayer that literally sucks the brains out of people. He grabs Jimmy here and sucks his brain out. But it looks exactly like the inflation monster that they depicted when the Aldrich Plan was created back in the early 1900s. So it's just kind of weird. And so what does a central bank do? Well, a central bank basically steals your wealth through this concept of inflation. Inflation is not normal. It's not good. It's not something we should hope for. From 1776 to 1913, a dollar was worth a dollar. Now, it had some ups and downs around world wars or civil wars, but the bottom line is it was worth a dollar because there was no one to deflate it away or inflate it away. Since the creation of the Fed, right? Jay Leno was right. We've turned a dollar into a nickel. So I always ask people, what's the cheapest price you remember for gas? I grew up in Seattle. Mine's 31 cents at 7-Eleven in Totem Lake. I paid $4 for a gallon of gas in California the other day. Same gallon of gas does the exact same thing. Instead of 31 cents, now $4. In fact, it's actually less good because there's ethanol in it now. So Jefferson and Keynes both warned us about the dangers of fiat currency. Lord Keynes said the best way to destroy a capitalist system is to debauch the currency. By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. It's a wealth tax, and that's what's going on. So what do? Right? They give you the illusion of good things. So property prices go crazy. My son lives up in San Francisco. You cannot afford, he's a married person who has roommates because they can't afford to live without roommates. It's craziness. And now people are going to realize you don't actually have to stay in San Francisco. You can work from anywhere. So maybe he'll move closer to home in North Carolina. So paper wealth exploded, real estate soared, but it's called money illusion. When the nominal price of goods and services goes up, and the nominal price of goods goes up, the value goes down. So what really is happening is the central bank created the greatest inequality in history. We had the greatest income and wealth inequality. In the upper right-hand corner, you can see that we used to actually have, some equality back in the 80s. Since then, right, since we went off the gold standard, the top 0.1% now have as much wealth as the bottom 90%. Just let that sink in for a second. That's crazy. So when equity returns seem too good to be true, right? Like the last 3 months, right? The Zimbabwean stock market was the best performing stock market in the world in 2005 and 2006. But you didn't want to own it because you ended up a starving billionaire. So that in the lower right is a picture. I actually have $100 trillion bill in my office. It wouldn't buy a loaf of bread. Think about that. 100 trillion. Remember, 1 trillion is $1 every second for 31,710 years. So you could be a billionaire in Zimbabwe and be starving. And that is what happens with money illusion. Your money gets debauched and the goods and services go up. So how about Venezuela? Nobody knows. Last 2 years, best performing stock market in the world. Venezuela. Did you want to own any Venezuelan stocks? I don't think so. Because here's the problem. That's how much money, okay, it's actually just toilet paper now. That's how many bolivars it would take to buy a chicken. The problem is there are no chickens. You can't get any chickens. So it's called a dictator playbook. So when dictators get in control, they create a cabal at the top. They channel all the wealth to their friends. It's exactly what's happening in the United States today. And then they devalue the currency. And as you devalue the currency, what do people do? They buy alternative forms of sound money, like Bitcoin, like gold. And so you see the rise in Bitcoin in places like Venezuela and Argentina. So in a challenging world, what do? Okay, if the risk-free rate is going to be 1 to 2%, and credit risk is 1 to 2%, so bonds make 1 to 3% if you're lucky. In emerging markets, you might make 4%. If the equity risk premium is gone in the developed world, you still make some money in emerging markets. Illiquidity risk still looks pretty good. So here's the problem. Everybody loves FANGman, right? FANGman, top 7 stocks, have a market cap today equivalent to the GDP of Japan and India. Apple alone is bigger than the Russell 2000. We've never seen stupidity like this in history. It's crazy. On a PE ratio basis, the rest of the world is far cheaper to the US, and we should be looking outside. Long short, there's never been in my career, other than 2000, a better time for long short. Our long short fund this year is up about 20+%. It's killing it, killing the markets. Why? Right? Because bad companies are going to go down not 5, 10, 15. They're going to go down 70, 80, 90, 100%. Wirecard, a good example of one of our shorts, it's down 99%. Bad companies are going away. And just like from 2000 to 2002, where hedge funds are able to stay flat in a world down 40, that's really, really good. But the real opportunity is in the private markets. Growth equity, venture capital, distressed energy. So what do the smartest investors do? Yale, okay? Third best performing fund over the last decade, not the top, but the third best. What do they have? They had 21% in venture capital. Why? Because innovation is where it's at. And what are the best venture capitalists investing in today? Blockchain technology and digital assets. Accel Partners, Blockchain Capital, Fenbush, Andreessen Horowitz. Andreessen just raised their second dedicated crypto and blockchain fund. We got into raising blockchain funds. Why? Why is blockchain technology so critical? Well, welcome to the digital age. Think about this, right? The largest hospitality company doesn't own any hotel rooms. When I went to Santa Monica, I stayed there for 3 weeks. I didn't stay at a hotel. I stayed at an Airbnb. I stayed in somebody else's place. Now I'm in Phoenix at a hotel with 3 people. Okay, that business is going to die. The largest transportation company in the world doesn't own any cars. So digitization is everywhere. And basically, it's just about connectivity. So in 1950, there were no connected devices. By 2020, by today, okay, there's 200 billion connected devices, right? That's 30 connected devices for every man, woman, and child on the planet. So it doesn't work with client server. It doesn't even work with cloud. You need a decentralized architecture. You need a new operating system for computing power. And this is just about this development of epochs in time. So we had the Industrial Revolution, we had the age of steam, we had the age of electricity, the age of oil, the age of information and technology, and now we're going to have the age of the blockchain era. And on the right-hand side, that green progression is maybe one of the top 2 or 3 most important slides in the whole deck. And what it says is that technology has migrated in this 14-year cycle. So in 1954, we invented the mainframe. And nobody wanted computers, but computers were a pretty good thing. And then 14 years later, the microchip, okay, was invented, and now smaller computers were available for small businesses. And then 14 years later, the PC was created. I grew up in Seattle. A bunch of my friends don't work anymore because they were smart enough to go to work for Microsoft. Now, if you've ever seen the picture, the original picture of the Microsoft 7, you wouldn't blame me for not going to work with those guys. They looked a little rough. But the reality is that it's been pretty good. And Steve Ballmer's mom said, honey, why would you work for that company? No one would want a computer in their house. He has 18 billion reasons he was right, mom was wrong. Fast forward to 1996 with the internet really changed everything. There's this great video of Bryant Gumbel and Katie Couric saying, what is internet? What is this @ symbol? Well, in 1996, we invested in this little company called Sequoia. They invested in this little company called Google. And $500,000 turned into $200 million for Notre Dame. There should be a quad at Notre Dame called the Google Quad. The internet's been pretty important. 2010, the mobile net, companies like Facebook and Amazon suddenly became hugely valuable because we all had these handheld microcomputers, supercomputers really, in the palm of our hand. In 2024, still 4 years from now, we will have the next wave, which will be the blockchain era. Now, what is blockchain technology, right? Blockchain is really simple. It's triple entry accounting. So we've had ledgers since the beginning of time, right? We had clay tablets and papyrus, and these were single entry accounting, meaning I lend you money, I write down on my clay tablet that you owe me money. Now you have to trust me that I wrote down the amount. Like if I gave you, 5 gold shekels and I wrote down that you owe me 10 gold shekels, that's bad. There's no check. So they came along with this dual entry accounting system back in the 1200s, and they said, all right, the Medicis said, no, we're not going to just trust that you wrote down the right number. We're going to have 2 entries, one on one side of the ledger, the other on the other side, debits and credits. Now, the problem with that is you have to have somebody who's the referee. Who would that be? The Medicis. Oh, we own all the banks. So we will create the greatest banking cabal, which is where the central banks all focus, and their job is to enrich the bankers, or the banksters, as I like to call them. Well, now we have technology where we don't need a trusted third party. We actually have computers through this global decentralized network that will verify transactions, and we can disrupt the entire banking cabal. So decentralization is superior. And the way to think about it, think about Napster. Remember when you wanted to share files, share songs? Now, Napster, you could copy a song, you could send the copy to your friend, and the friend didn't care if they got a copy or the real one, the original. But who cared? Well, the music industry cared. Well, why did the music industry care? Because, well, they wanted everybody to buy an original. So they shut down Napster. Now, how do you shut down a centralized company, right? You arrest the CEO and you blow up the server. So a centralized company is what everything in the world is based on. It's all hierarchy. It's about leveraging the guy or gal at the top, mostly guys, unfortunately. And it's about a single brain being better than everything below it. So one CEO, one home office, that's a logically and architecturally centralized business. But that's inferior to a decentralized, right? So I'm having a conversation with you in English. My son is out in the hallway doing his bilingual school. He goes to a bilingual school, and he's speaking Spanish or English or Spanglish. And we're having the same conversations, but we're doing it independently. And that's a decentralized world, far superior. Now, blockchain technology will impact every business model, from government to supply chain to legal to voting to food. Everything that you can imagine will ultimately run on a blockchain. And the reason is, if you think about blockchain, go back to our original thing. In the old days, right, mainframe computers ran on Fortran and COBOL. That was their operating system. Then microcomputers ran on Spark and Unix, right? That was the operating system. And then the personal computer came along, and it was DOS and Windows, the operating system. Then we had the internet, and you had TCP/IP, which is the operating system for the internet. Then we had the mobile net, and we have iOS and Android. Think about this. Google bought Android in 2005, and everybody said, what the heck are you doing? Why, that's stupid. Well, now they have 80% market share of global mobile phones. Crazy. They were so smart. So it's control of the operating system. In 2024 and beyond, blockchain will be the operating system for the internet of everything. And I'm going to make a big statement that the blockchain era will usher in a period of unprecedented wealth creation. The opportunity to create wealth by investing in blockchain technology is the biggest wealth generator we'll see probably in our lifetimes. And it's because we can decentralize trust, and we can transact value without intermediaries. And that will unlock trillions and trillions and trillions of dollars of value for those that invest and take advantage. Now everybody says, oh no, Warren Buffett says well, it's funny. So Jamie Dimon calls it a fraud. Warren Buffett, right, said it's like rat poison. I always say, well, how do you know what rat poison tastes like unless you're a rat? But his partner, Charlie Munger, went one up. He said it's like trading newly harvested dead baby brains. WTF, Charlie, really? Well, why do they want you to hate it? Well, think about it, okay? Berkshire Hathaway has 46% in financial services. Jamie, 100% in financial services. They really don't want something that will disrupt financial services. Now, crypto is not new. It's been around since 1988. This guy, Tim May, wrote the Crypto Anarchist Manifesto. The problem is, in 1988, okay, the economists picked up this idea and said, we're going to have a global currency, right? They said by 2018, we would have a global currency called the Phoenix. Pretty amazing, 30 years ago. It took 20 years for Satoshi Son, whoever he, she, they are in the middle, to come along and actually create Bitcoin. Now, why was that important? Well, it was important because Tim May was an anarchist. Anarchists don't have any friends, so they don't influence people. So it took someone like Satoshi who could bring it to the world, and now it's called the future of money. Now, one problem, they always depict it as a gold coin. There's no gold and there's no coins. It's like calling Madoff a hedge fund. There was no hedge and there was no fund, right? He just stole people's money. He actually didn't have a fund. So what we're talking about, the internet of money, as Andropoulos calls it, or the internet of value, as I like to call it, or the trust net, which is my new term. It's basically every stock, every bond, every currency, every commodity, every piece of money, every property title, every airline mile, every business, everything, every asset in the world will be digitized as we go from the analog world to the electronic world to the digital world. And once it's digitized, it can be moved across the internet as seamlessly and easily as information or commerce. And think about what email did to communication. Think about what e-commerce has done to geographic commerce. So basically what blockchain does is it provides a single source of truth. We don't have to trust anybody else. We trust the code, and we trust this machine that gives us the source of truth, and therefore the trust net. Now, money, the history of commodity money is pretty solid, pun intended. Okay, fiat currency, not so much. So we've been using all kinds of things for money, from puka shells to gold coins to copper coins. And the Roman solidus, right, use a piece of gold, 2,000 years ago was the most powerful currency in the world, right? The word solid comes from that. You were a citizen, you were solid if you had a solidus. The problem is now solidus is a trinket, right? You can buy one for $1 in Italy. The problem is we created fiat money, which means it can be created out of thin air. And the problem with fiat money is it can be devalued. Now everybody says, well, Bitcoin has no value. There's nothing behind it. You mean compared to money? What's behind money? Oh, full faith and credit of the government. No, it's not. You can't turn in your money to the government and get anything. You used to be able to get gold or silver. They don't give you a share of tax revenues. They don't give you anything. The only thing that backs money is faith. Faith that you can exchange it for a good or value or a goods and services. Now, this might be the most important chart in the whole deck. And basically what it shows on the right-hand side, gold has been money for 5,000 years. Think about it, 1 ounce of gold for 5,000 years by the fine man's suit. In 1979, the fiat fiasco, we went off the gold standard and we created fiat for everybody. And fiat will eventually disappear, and cryptocurrency, started in 2009, will eventually replace it. So on the left-hand side, you can see Bitcoin went to $100. It's a bubble, it's a scam. It busts, it goes back to $2. Oh, see, we told you. Okay, then it goes to $1,000. Okay, then it crashes back to 200. See, we told you it's a scam. Then it goes to $3,000 and it crashes. And then it goes to $10,000 and it crashes, it goes to $20,000. Well, every one of those lows is higher. And so all that volatility you see on the left is actually embedded in the blue line on the right. And over time, cryptocurrency will replace all fiat currency. Why? Because fiat currency is useless and wasted. And it's all because the banks use it to steal our wealth through inflation. So we will replace the banking industry the same way email replaced snail mail, the same way that e-commerce is replacing regular commerce. We'll replace banking with these digital business models and we'll disrupt them. And so what the internet did to media, blockchain will do to financial services. And look, the WEF even said that blockchain will become the beating heart of the new financial system. Now, banks have been under attack forever, right? Do we really need banks, actually? We got direct peer-to-peer lenders, and we can take our money and we can put it in a company like BlockFi, which is a portfolio company of ours, and we convert it to fiat. If you take fiat money today and give it to BlockFi, they'll pay you 8% interest. 8% is way better than half that you get in the bank. And you can hold a stable coin, which has no volatility of a crypto, but there's a demand for stable coins as we move to this digital age. Now, here's the other thing. 40% of adults in the world are unbanked, but 2/3 of them have a mobile phone. So we can create mobile applications using blockchain that allow them to have the services of banking, don't call them a bank, but blockchain financial services that will bank the world and bank the unbanked. Now, why does this matter? Well, a couple things. Analog, right? We still use analog for everything, right? We have physical stock and bond certificates. Why? Ridiculous. Now we have electronic QSIPs that we trade, but there's actually a physical stock certificate that sits in DTCC in Texas. Silly. And it's high cost. And you remember, if you have to trade physically, you have to be proximate to one another. If we're digital, we have a global marketplace. We can trade 24/7. We can fractionally own assets. We have cheaper transaction costs. And it basically creates a global marketplace that will grow and again, create a wealth curve that like nothing we've ever seen. So again, every year, $14 trillion of assets, stocks, bonds, real estate, commodities, works of art, are transacted. All of that will turn into tokenized representations, digital representations. And then imagine, how many people could own the Plaza Hotel in New York? I don't know, a couple thousand, gotta be a multi-billionaire. All right, how many people would like to own a piece of that iconic piece of real estate? 1 million, 2 million, 10 million? A lot. If we tokenized it, everyone could own a share and it wouldn't matter where they lived. Now here's a big number, 700 trillion of total assets globally, okay? That's liquid assets, illiquid assets, businesses, stocks, bonds, real estate. Every asset in the world will be tokenized. Every asset in the world will be digital. Every asset in the world will trade on digital exchanges. It will all be powered by blockchain. Now, people say, it's just a bubble. It's going to bust. Well, of course it's a bubble and it will bust because that's how new technology works. It gets really excited, then it busts, and it gets really excited, then it busts. If you think about it, how about Netflix? How many times does Netflix almost go bankrupt before it actually became a real company? Because they were early, right? The first Netflix was a horrible company, little disc, and they got broken or lost. And then they tried video on demand. Well, that didn't work because video on demand didn't work. In the early days, it took 40 minutes to download a song. Okay. It took 120 hours to download a full-length feature movie. Couldn't wait 120 hours. No one would wait that. Today, instantaneous, right? We can stream in real time. Technology will evolve and people will adopt it. The Lindy effect. The longer something stays alive, the longer it will stay alive. And blockchain and crypto are here to stay. So investing in blockchain and Bitcoin today is like investing in Yahoo or Google in 1996. It's like 1996. And on the right-hand side, every technological innovation has these growth curves. We are so early in the adoption. Again, 2024 is the aha moment where everybody says, oh, this is actually a thing. Now, this exponential curve is really important. So people have a hard time with math and they have a really hard time with exponential math. If you take 20 linear steps across this hotel room that I'm sitting in, you'll get to the other side. If you take 20 exponential steps, you go around the world twice. Just let that sink in for a second. So the left-hand side, think about that as Internet Web 1.0. That was companies like Cisco and Microsoft and Intel. It created some value. Then you have Internet 2.0 in the middle, and that's the knee of the curve, the exponential curve, and that's Amazon and Alibaba and Facebook. That created even more value. But the blockchain era is where we get the asymptotic right-hand side of the curve, and we get massive trillion-dollar wealth creation. So we're going to follow the S curve of adoption. We're in the middle of the frenzy. We will have a bust in 2024, and then the big companies. Remember, think about Amazon, right? Who bought Amazon at the IPO 20 years ago and held it to today? No one, except Jeff and his mom and dad, and maybe his ex-wife, but that's it, okay? No one else did. Why? Because on average, Amazon has had a double-digit drawdown every year in the 20 years, including this year, average minus 31% and twice more than 90%. Volatility is normal, and volatility is your friend in the adoption of new technologies. So this is a exponential growth curve called Metcalfe's law that predicted in 2014 that Bitcoin would be $10,000 in 2017. Nailed it. Says it'll be $100,000 in 2021. I'll bet you it'll hit that too. Why? because of this model, the stock to flow model. If you think about assets, the more scarce an asset is, the better it does in a fiat currency world, because the fiat currency is devaluing your money. So scarce assets do better. Collectible Porsches, rare wine, island real estate, gold, silver, and Bitcoin. So as Bitcoin moves up this line to approach silver and gold on the right-hand side, the value of a Bitcoin could be very large. So when you overlay the stock to flow model and the original Metcalfe's law model from 2014, you get, unsurprisingly, $100,000 Bitcoin in 2021. Yet everybody in the world says everybody's leaving, everybody should get out of Bitcoin. Bitcoin's going to zero again. It's been declared dead 393 times. The reality is, I've never seen in my career, other than in 96, the highest quality people in the world are leaving banks, law firms, technology companies, and going to work in crypto. So it's the early innings, right? We have individuals like Jeff, whose net worth is bigger than all the Bitcoin put together. So it's time to get off zero. So the investment landscape is changing, demographic changes, the digital divide, regulatory changes. This is a new asset class, although it's really not. It's just a digital form of existing asset classes, stocks, bonds, currencies, and commodities. We know when we had an uncorrelated asset, right-hand side, we get a better portfolio. We get lower risk and better return. This asset, Bitcoin, is the only asset in my career, and I've been around a long time, I got white hair to prove it, that I've seen that actually delivers on the promise of low correlation. Why? Because stocks and bonds derive their value from the same thing: corporate profits, economic growth, interest rates. Crypto derives its value from investor adoption, the number of millennials, because they are digital natives, network growth, and regulatory and technological developments. Nothing to do with economic growth, the Fed, and that. So it will be a low correlated asset. And the beautiful thing is 1%. If you put 1% in Bitcoin, 0.5% from stocks, 0.5% from bonds, over the last 5 years, you added about 20% to your return. If you add 3%, you add about 6% to return, 60% improvement. If you add 5%, 2.5% from each, you doubled the return over the last 5 years. If all the endowments had taken 1%, 0.5% from stocks, 0.5% from bonds, over the last 5 years, instead of making 7.2%, they would have made 9.2. And had it gone to zero, which 5 years ago was still possible, not possible today, okay, they would have made 7. That's a 10-to-1 upside downside ratio. So the ostrich model, hoping it goes away, that's just not going to work. 2 ways to invest: picks and shovels, or the crypto themselves. We actually have funds that do both. That's it. I always have to show this last slide because here's the crazy thing. In the US, we graduate 500,000 engineers every year. China graduates 4.5 million. But for every lawyer they graduate in China, we graduate 40. They're a country of wealth creation. We're a country of wealth redistribution. So with that, I'll turn it back to Vince and take any questions. Vince, you might be on.
Well, I'm off mute, I think, but
Okay.
I think Michelle still has me blocked from a video. So, oh, here we go.
All right.
There we go. All right. So, yeah, have a few questions.
Great.
So, first question that came in was, what's the value of Bitcoin and other digital assets if the Fed U.S. government creates a digital U.S. currency? Is it just validation of the technology?
Great question. So fiat money will always be a bad thing, right? Fiat money will always be able to be devalued at the whim of a government. So all a digital currency is very different than a cryptocurrency. So a digital currency is just a digital form of the existing money. So if you think about it, in the old days, every country had analog money, right? They had paper and coins. Today, 92, 93% of money is actually electronic, right? It's just ones and zeros. In fact, I have this recurring nightmare that I go to the ATM and I punch in my code and it says I have $0. I was like, well, how would I prove that I don't? I don't have statements anymore. It's just my word against the banks. That's really bad. So electronic Very different than analog, right? I don't physically have the money. I got to get it out of the ones and zeros. Digital is different. Digital, I don't have to trust the bank. If I have a digital money like Bitcoin, the network says, Mark has this Bitcoin. Everybody can see that I have that Bitcoin. No one can take it away from me. Bank can't say, oh, sorry, you don't have any money. Electronic can, vanish. It also can't be devalued by the Fed. Like if the Fed has $1 trillion here and they print another trillion, what just happened to the value of that money? Well, it just declined because there's twice as much money chasing the same amount of goods. So what's going to happen, most likely, China will be first. China will have a digital renminbi. Russia will be second. The US is lagging because the US doesn't get it for some reason. And why it's important is the world reserve currency has always followed naval superiority for 700 years. So it started with the Portuguese. They had the tallest trees, so they had the fastest ships. Spain took them over. They had the tallest masts, so they had the fastest ships. Then France took them over. The Netherlands took them over. The UK got the steam engine, so they had the fastest ships. Then we got nuclear, and we have the fastest ships. The problem is the next war will be fought with chips, not ships. And so what China has figured out is they've spent more money on AI and 5G than anybody on the planet. And they now have technological superiority, and they're closer to creating a digital currency. And when they create a digital currency, not a cryptocurrency, but a digital currency, what that will allow is people around the world not to have to use dollars. Because today, 8% of global trade is with the United States, but 60% of global trade is financed in dollars. If their digital renminbi comes out, some portion of that will go there, and they'll move closer to being perhaps the world reserve currency. Now, the US will eventually catch up, and they'll probably do a digital currency, but a digital currency is not a cryptocurrency. A cryptocurrency must not have a central bank that can issue by fiat. A cryptocurrency must have a fixed supply mandated by code like Bitcoin, and therefore it can't be inflated away. So it's sound money. And the stock to flow ratio is what matters, is the new production of coins, whether it be gold, silver, or Bitcoin, which is why Bitcoin trades like digital gold and why it is a perfect store of value and why I think it will eventually replace digital currencies over the long term. But that's a long answer, but that's a really, really important question. The difference between digital currencies and cryptocurrencies.
All right. Another question here. Person comment, I see blockchain technology and cryptocurrencies as separate things. I see the technology is extremely useful to do things like real estate transaction, buying, selling cars, etc. But he doesn't see the use of crypto in particular, like the currency side. So can you compute the two?
Sure.
Why
Look,
both are important, or why one's not valuable and cryptocurrency is not as valuable or will go away?
Yeah. So look, it's very in to say blockchain, not Bitcoin, but it actually doesn't make any sense. I mean, they're not separate at all, right? Bitcoin is simply the first mass application of blockchain technology, right? It is blockchain, right? Blockchain and Bitcoin are the same thing. And cryptocurrencies, whether it's Ethereum or whether it's any of the other stable coins, or it's all interrelated, right? They exist together. So you can't separate them. They have, blockchain is a technology. It's basically just triple entry accounting, and it can be used in myriad ways. Currency is only one of those ways. It can be used for provenance, right? Think about lettuce, right? We have lettuce, you get salmonella, it gets recalled. Well, today you recall everything. That's silly. We know where the contamination happened. We know what farm it is. If we could track all the lettuce that came from that farm, we could recall that lettuce and leave all the other lettuce out there. So provenance is actually great. Or how about, blood diamonds versus, regular diamonds, or cobalt, not coming from Democratic Republic of Congo. So we can track, the provenance of where things come from. Maersk has said that they can save about $1 billion or add about $1 billion to their EBITDA by using blockchain to help with logistics and their transportation business. Well, they only have $2 billion of EBITDA, so $1 billion extra would be a lot. So blockchain technology has lots and lots of applications. Cryptocurrency is one application. The value of cryptocurrency is it allows store of value, right? So it's, everyone should have a piece of cryptocurrency, particularly Bitcoin or Ethereum, in their portfolio because it's a perfect store of value. It also has medium of exchange potential, right? Why do we pay Visa, MasterCard 3% for every transaction? Doesn't make any sense, right? I can send Bitcoin around the world for free. Now, free is the wrong number too. Or why would I pay Western Union 12% to transfer money to Brazil? Silly. The reason I do is because the Rothschilds 400 years ago set up a treaty that any international transfer of money has to go through two banks, of which they own a piece of both. That's why it costs 12% to transfer money to the Philippines or Brazil. That can go away tomorrow. All of these things will eventually be replaced by the operating system that is blockchain technology, that is crypto. And think about the internet. So there were 80 internet protocols, TCP/IP, HTTP, SMTP, all these protocols. And for 20 years, they fought it out, and eventually 5 protocols became the norm. So we have TCP/IP, we have HTTP, we have SMTP, we have FTP, and we have www. The same thing is going to happen in crypto. So Bitcoin will be the primary rail, like TCP/IP. On top of that, we may have Ethereum as the www. Then we might have Filecoin as the FTP. We might have Polkadot or Cosmos. Who knows what the others will be? But we'll end up with this technology stack the same way the internet, and it will become invisible. And in the future, every transaction will go across the Bitcoin blockchain, right? Every transaction. Now, it'll probably go on the Lightning Network or some other secondary rail, the same way that Visa and MasterCard process all the transactions, but all they're doing is keeping a spreadsheet of my spending for 30 days and then settling up at the end. They don't really do very much, except it's convenient and it's easy. But ultimately, we'll have digital wallets, we'll have digital assets. Our digital assets will be resident in this digital world. It'll be faster, cheaper, better. We'll get rid of the rent-seeking middlemen like Visa, MasterCard, and the banks, and will disrupt financial services the same way media, communication, commerce has been disrupted by electronic.
All right, and we'll make this the last question. We're right at 1 o'clock here, but we'll let this last one in. What's the best way to invest in the cryptocurrency market?
So a couple things. So it depends, what you're after, right? If you want a long-term store of value, right? You should just literally own Bitcoin directly. And you can do that lots of different ways. You can own it through an exchange like a Coinbase or a Gemini, the Winklevi. You can actually, if you don't want to deal with an exchange and cold storage or a hot wallet. And by the way, it's money. So never put a lot on a wallet, just like you'd never carry a lot of cash because you might lose it. Don't put all your Bitcoin on your phone because someone could hack into your wallet and steal it. And think about this. People talk about, it can be hacked, right? The Bitcoin blockchain has never been hacked, not once. It's been around for 11 years, hundreds of millions of transactions, hundreds of billions of dollars, never one hack. How many times have you had to change your Visa number? Lots, because they get hacked all the time because they're not as secure. In computing, you have a choice, speed or security. Bitcoin is very slow, but it's the most secure computing network on the planet. Visa is very fast, but it's not very secure. But they pay for it because they have insurance. So you have to choose where you get access to an asset. So if you think about how much money has been stolen from the Fed, 0. How about from Bank of America, New York? 0. How about Bank of America in Charlotte? Still 0. How about Bank of America in El Paso, Texas? Yeah, probably some. So how about in your wallet or purse? Lots. The further you are from the source of money, the more risky it is. So if you're going to have crypto on your wallet, on your phone, have the same amount that you'd be willing to lose if you had money in your wallet. The rest should be in an exchange like a bank or a broker. Or you can own an asset like GBTC, which is a trust that owns Bitcoin. Now, you pay fees for that, and you also have to pay a premium like a closed-end fund. So you can go to ABTC, which we own a piece of Amun that does this, but they're a Swiss-based trust that doesn't trade at a premium. So you can do things like that. So the simplest way is to just own a ticker symbol like GBTC, because then you don't have to deal with anything. The next best way is to own through a Coinbase or Gemini, or BlockFi is another great place, or Cash App. But make sure it's in storage, and that you have that you treat it the same way you treat your own money. You don't put all your money in your wallet. You don't put all your money in your bank or brokerage account. You have it dispersed in different places with different levels of security. So the same thing is important for Bitcoin or crypto.
All right. Well, Mark, I really appreciate the conversation, the presentation today. For everyone else, one housekeeping note is that our forecast launch, our annual forecast launch that was scheduled for November, that is being moved to April 16th of 2021 due to COVID-19 and still the restrictions of large gatherings. So unfortunately, mark that on your calendar, and we'll be moving that to April 16th. And for anyone that wants to have a post discussion on this, please stay on the line here. We'll give it a couple minutes, and then Michelle will promote whoever wants to have that discussion to a panelist so that we can all chat and have some more conversation.
Vince, Michelle, thanks for having me. Guys, thanks for listening, and hope to do this again sometime.
All right, Mark, appreciate it. Thanks a lot.
Take care.
Hey Vince, you and I are the only ones who can hear each other right now, I believe.
Okay.
Oh, no, maybe not. No, we're still we're still broadcasting.
Yeah, so how are you gonna